This is an uncovered Japan company research report on Japan Aviation Electronics or JAE, ticker 6807. JAE is Japan's number 3 connector maker and a global top 10 player. The question is whether its aerospace franchise, its Kyocera partnership, and a move toward higher value connectors can improve returns in a much larger, low-margin business. The market snapshot captures the tension. The report puts JEE on a forward price-to-earnings ratio of 26.8 times, even as fiscal 2026 return on equity was only 5.1%. It has net cash of 6.7 billion yen and a 62.1% equity ratio, so financial resilience is not the problem. The investor debate is whether operating returns can catch up with the valuation. JAE makes the small electrical connectors that link components inside cars, smartphones, factory robots, data center switches, and aircraft. Customers choose these parts during product design because reliability, size, heat resistance, and manufacturing consistency matter over a system's life. This is a business-to-business component market. The product is inconspicuous, but a qualified design-in can remain in place for years. The financial record explains why the recovery case matters. Revenue moves sideways from 225.1 billion yen in fiscal 2022 to 227.9 billion yen in fiscal 2026. Operating profit, however, fell from 18 billion to 8.9 billion yen. JAE is not simply a slow growth story. It is a margin story, with operating leverage and product mix doing most of the work. JAE's economics are uneven. Connectors account for 87% of sales and earn a 6% margin, while aerospace and airframe work is only 9% of sales, but earns a 10.7% margin. The aerospace franchise is valuable because qualification, reliability, and maintenance requirements are high. But the investment case still depends on lifting returns in the much larger connector business. Cash flow reinforces the pressure. Fiscal 2026 operating cash flow fell to 17 billion yen, and free cash flow turned negative by 7.4 billion yen. The net cash balance sheet gives JAE room to invest through this period, but it also makes execution more important. A recovery must eventually show up in cash returns, not just in strategic language. JAE's moat is practical rather than glamorous. Automotive customers commit suppliers at the design freeze stage, and aerospace qualification creates even higher switching costs. A global manufacturing footprint supports customers locally. The limitation is that much of the connector portfolio remains exposed to standardized, price-sensitive applications, where material costs and competition can compress margins. Capital allocation has been unusually consequential. A 2024 self-tender reduced the equity base, yet return on equity still fell to 5.1% in fiscal 2026 as profits weakened. That is an important distinction for investors. Financial engineering can change the denominator, but durable return improvement requires JAE to restore operating profitability in the core business. The major strategic change is Kyocera's arrival as a 33% top shareholder after NEC's exit. The partnership could improve procurement and support a move toward higher value products. AI data centers, automotive ADAS, and defense also create demand tailwinds. But those are opportunities, not proof. The fiscal 2028 plan depends on turning partnerships and technology investment into better mix and pricing. Valuation is the hard part of the thesis. The report compares JAE's forward price-to-earnings ratio of 26.8 times with a 5.1% return on equity. Best-in-class domestic peer Hirose trades at a lower 23.6 times multiple while earning a 12% return on equity. The market is therefore paying for a recovery that JAE still has to deliver. The research's scenario framework makes the asymmetry visible. Against a June 9th reference price of 2,381 yen, the 3-year bear, base, and bull illustrations are 1,250, 2,350, and 3,500 yen. These are not recommendations or price targets. They show which variables matter most: margin recovery, Kyocera synergies, high-end mix, and valuation discipline. To sum up, JAE combines a real aerospace and defense moat with a globally relevant connector franchise and a sound balance sheet. Its vulnerability is that the biggest business remains low margin, while the shares already reflect a meaningful recovery. Watch the core connector margin, cash conversion, higher value product mix, and evidence that the Kyocera partnership improves execution. This is not investment advice. It is a starting point for your own research. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.